In this video, we're going to look at how to calculate the marginal propensity to consume, MPC, the marginal propensity to save, MPS, and the tax multiplier. Now suppose the consumption function is C equals 200 plus 0.8y. The planned aggregate investment, or I, equals 400, and the government expenditures or spending, G, equals 100. In this case, the MPC is the coefficient of y, which is 0.8. Given that MPC plus MPS equals 1, the MPS in this case, or marginal propensity to save, equals 0.2. The tax multiplier is defined by minus b over 1 minus b, or negative MPC over 1 minus MPC. After plugging in our value for the MPC, which is 0.8 in this example, we have a tax multiplier of negative 4. Now what does this mean? This means that the aggregate income or output Y will decrease by $4 for every $1 increase in tax. If the government imposes a $10 tax, for example, the aggregate income or output will decrease by $40. Remember that aggregate expenditures equals C plus I plus G, or aggregate consumption plus planned aggregate investment plus government expenditure or spending. After substituting our consumption function, 200 plus 0.8y, but we include the imposition of a tax. Therefore, we have 200 plus 0.8 times y minus t plus 400, which is our value for planned aggregate investment, plus 100, our value for government expenditures or spending. In our example, the government imposes a $10 tax. Therefore, we substitute 10 for t. After expanding and simplifying the like terms, we have aggregate expenditures equals 692 plus 0.8y. Remember, at the equilibrium, y equals AE. Now, we have defined earlier that AE equals 692 plus 0.8y. After subtracting 0.8y from the right-hand side and left-hand side of the equation, we have 0.2y equals 692. After dividing both sides by 0.2, we have y double star, our equilibrium aggregate income or output, equals $3,460. On this slide, we can see the effects of the tax multiplier graphically. At the equilibrium y star, before the government imposes any tax, we have y equals AE, or aggregate income or output equals aggregate expenditures. Remember, aggregate expenditures can also be defined as aggregate consumption C plus planned aggregate investment I plus government expenditures or spending G. Before the government imposes any tax, our aggregate expenditures AE equals 700 plus 0.8y. Therefore, y equals 700 plus 0.8y at the equilibrium y star. After subtracting both sides of the equation by 0.8y, we have 0.2y equals 700. Therefore, y star, or our equilibrium aggregate income or output, equals $3,500 before the government imposes any tax. At the equilibrium y double star, again, y equals AE. Now, after the government imposes a $10 tax, as we saw on the previous slide in our example, our aggregate expenditures, or AE, equals 692 plus 0.8y. Therefore, y equals 692 plus 0.8y. After subtracting both sides of the equation by 0.8y, we have 0.2y equals 692. After dividing both sides by 0.2, we have y double star, our equilibrium aggregate income or output, equals $3,460 after the government imposes a $10 tax. Therefore, the aggregate income or output Y decreases by $40 from $3,500 to $3,460 due to a $10 tax. Aggregate income or output Y decreases by a factor of the multiplier, negative MPC over 1 minus MPC, in this example equaling negative 4, from Y star $3,500 to Y double star $3,460 as tax increases by $10.
Thank you for watching. Please like, share, and subscribe.